Good morning, everybody. Welcome to the Flow Show. Hope you're doing fine and dandy on this very wet Tuesday, the 8th of October. Absolutely bucketing it down since about, well, I can tell you when, 4:13 last night or 4:13 a.m. That's when I woke up to the torrential downpour. But still, we're not in Florida. So any of you Yanks over there, if you're listening in, I do hope you stay safe and things pass you by without much ado. But it's looking like it's going to be a bit of a big one, this next hurricane passing through. So wish everyone well over there. Morning, Kay. How you doing, mate? Got your flippers on?
Good morning, Ryan. Good morning, everybody. There's this saying that rainwater is good for the hair grow, but I can confirm it's absolute bollocks.
I could have told you that years ago.
I'm joining you obviously to wish everybody well with those hurricanes arriving. Please be safe, everybody. It is a nasty one coming over. So hope everybody will stay safe and return to us with having seen that it's perhaps not as bad as expected. Let's hope for everybody. Yeah. For the rest, mate, as I said in the room, there's a reason why England is so green, right? We're getting enough water here.
Yeah, there's always too much water, but yeah, certainly no hosepipe bans for a while. But anyway, yeah, my fish are loving it. Me less so. Right, let's get cracking. Lots to get stuck into. Lots coming up as well that we need to go over. Right, well, first things first. China has. You could say China's disappointed markets, but I think, you know, with hindsight being a wonderful thing, it looked like the market was built up its own expectations for this one, and then been disappointed when it hasn't got what it expected, because we had the various Chinese entities, authorities, NDRC and that sort of thing, and the China State Planner coming out with lines, but none of it added to this opium trade that was going on. The China State Planner is the main one. They pretty much gave the usual waffle, saying we will promote sustained, stable and healthy economic development in 2024-25. We will expand domestic demand and prioritise consumption. We will strive to boost capital markets. So all pretty much standard fare. No big news, no new stimulus measures, no new grand plans to boost growth, as we touted last week was the expectation. So a little bit of the opium trade has come out. Chinese stocks, they had a big open when they came back from their holiday. I think it opened up 11% or something, but or shot up 11%. But that has faded somewhat after that state news took a bit of the wind out the sails. Whether this is just a bit of a setback or what, we don't know. They have got their own hedge funds and financials in buying stocks, so I hardly think that's going to dissipate. It's probably still a massive BTFD in Chinese stocks, and no doubt all the latecomers are now coming to the party, and we'll start chasing it higher, which probably means we've got a bit of a topping. But anyway, we know what's coming from China. We're now, again, still in a position where they might lob a few more kitchen sinks at it. But now all the talk has got to turn into action, and we've got to see some reaction from all these moves, which is not going to happen overnight. You got any thoughts on China at the moment, mate?
Yeah, first of all, when we look at what happened on the equity markets, I think while the Chinese markets were closed, people found refuge in the Hong Kong markets, and we've seen a bit of a scissor kind of effect, right? As well, I think some let go of their Hang Seng and what other futures perhaps they were in, and then bought the rest, the more traditional ones. Yeah, I think your assessment of the situation is correct. The market is living on opium. We all know that despite geopolitics, China is supposed and should still be some kind of engine of the world, especially for Europe as well. And they may be maybe a little bit disappointed, but I don't think we've seen the end of it, because if we look at all those rate cuts and plans that they put in place over the past weeks, it's the China economy, the big economies, although the US is a pretty dynamic economy, but if you look at the older economies, let's say like Europe and maybe China being so vast, is can be ranked into the same bucket. It's going to take time for everything to show up. So I wouldn't say that this is the start or the end of, but and it's going to take time. Now, the moves we see is a bit typical of what I've been calling those accelerated cycles in what we see in the market now. Everybody wants to jump from the left to the right hand side of the ship when somebody else spots a whale. And that is what we see now. When we see these outside moves, we've seen, for instance, if you look at how the yen has been behaving over the past months, even a year now, really, those very big moves, and even in bond markets, the market is constantly swinging the pendulum around. And I think we are going to see the same in China, but I'm actually going to say that we may even have to wait for 2025 to see completely clear on where China is going to go. In the meantime, I would suspect that after those knee-jerk reactions, investors will turn around and still keep geopolitics in the back of their mind, and perhaps not jump fully into Chinese assets. So I think we are in for a period of volatility over there, and then we will see when the dust will really settle, whether they get their economy back on track. Everybody is accepting that 5% is what they need as a growth, and many people think that they will miss. But then we will see what the Chinese come up with as their own numbers, because we know that they are most of the time a bit massaged as well, right?
Yeah, no, absolutely, mate, absolutely. Just want to answer Ali quickly. Yeah, if you do follow our feed and some of the analysis pieces that go out, you can often tell by the chart who put what up and who wrote what. So it was Blake who did dollar Swiss yesterday, and I did dollar CAD this morning. Yeah, I don't know what positions you took, Ali. Did you buy off support in dollar Swiss? I don't know what you did in dollar CAD. Let us know. Obviously, we'll have a look at that as well. Right, moving on. Over in Japan, a little bit of a reminder what an uphill battle they've got over there to get wages and the likes higher. We saw overall wage income of 3% coming in as expected, down on the lower revised 3.4% previously. However, the worst news from that, and it's not shown there, of course, is it? Nope. Is that wages on real terms fell 0.6%. Previously, it was up 0.3%. It was expected to drop to minus 0.5%. Came in at minus 0.6% real cash earnings. So that's the number that Japan is looking at, the government are looking at. They want real wages to get into positive territory. So as I say, a little bit of a reminder that they've got a lot of work to do over there. Now, here's something, and it might explain a lot in terms of some of the moves we saw in August. According to the Ministry of Finance, their latest records, they bought a record amount of US sovereign bonds were acquired in August, which at the moment, or did at that point, look like a good trade if they were getting in yields up in the high 3.9s, 4% area. Kay, was that Japan locking in some yield there while yields are still crappy over there?
I spoke about it, and on the shows, I spoke about that they were putting their money to work, and I still think they did. Well, it's two things really. You buy bonds when you think the yields are going down, or you buy bonds in the event of something happening in your own country. And that's what I said at the time. I think Japan is putting in its money to work. You can get over well, on a yearly basis, and it depends for how long they keep it. But even if they keep it only for 1 quarter, they will still get. If you look at the 1 year or 2 years, let's say if you keep it for a quarter or 2 quarters, you will get as much as you get in the JGB 10 years. I think it's a case of putting their money to work in the event of what the Bank of Japan was going to do. But yeah, I spoke about that at the time. I said, like, really. And that was one of the reasons why I wasn't really actually looking at levels to get rather long dollar yen. But I do think that they did most of it on a hedge basis, so it did not have too much of an impact on the dollar yen, because actually we saw dollar yen coming down, and they need to go unhedged if we need to see an impact on the dollar yen, right? But yeah, I think it's that case, parking money for somewhere relatively free if you do it on a hedge basis, because you don't risk the effects. You pay it away straight away, but you don't risk the effects if you hedge it, right?
Yeah.
But yeah, I think they've been parking their money there, and then waiting for the Japanese yields to go higher, to then perhaps get back into Japanese bonds. But that may have to wait for 2025, and that is something that we will have to keep a close eye on, because if they are going to do the switch at one stage, then you are going to see a big move in US bonds and JGBs as well. And actually, with the size that they have, they could actually pull US yields higher if they sell a lot of bonds and repatriate. So we will have to keep an eye on when they start to have several weeks of going the other way around. But I do think that they are still waiting for the Bank of Japan to put the yields at levels where they feel comfortable of repatriating some.
Yeah, and just to confirm, because I can't remember, this MOF reporting, that's reporting of financials, not the government and the MOF buying bonds, right?
Come again?
This MOF report that show a record amount of bonds bought in August, US bonds bought in August, that's reporting of financial institutions and the like buying bonds, not the Japanese government.
No, I think it's no. I think that there should be. I haven't seen the report, Ryan, but there should be different lines in there on reporting what they did in detail. But I haven't seen the report. I'll have a look at it.
Yeah, I need to probably have a look. I should have had a look at it before I started the show, but anyway, we'll have a look at that afterwards. Economy Minister Akazawa, just talking again about the cash earnings, said that the decrease in real wages for the first time in 3 months is not good news, and then went on to push the party line that the government will create an environment where real wages continue to rise. So you can tell they're keeping a close eye on that data. Over in Kangaroo Land, the RBA minutes were out. A load of every which way waffle, as per usual. Apparently they discussed scenarios for lowering and raising rates in the future. And these 3 lines in the minutes sum it up perfectly. Policy could be held restrictive if consumption growth picks up materially. Policy could be tightened if present financial conditions are insufficiently restrictive to return inflation to target. Policy could be eased if the economy proves significantly weaker than expected. All bases covered there by the RBA at the moment. They can't lose. They also said it's not necessary for the cash rate to evolve in line with policy rates in other economies. Basically saying that they're not going to follow other economies. If everyone else is cutting rates by big chunks, it doesn't mean they're going to jump on board and follow suit, but I bet they do if the case arises. RBA's Hauser was out later on saying US CPI moved closer to target. Australia's CPI hasn't. Well done. They're waiting for core inflation to move sustainably to goal. And inflation in Australia is proving very sticky, and bringing down inflation is a big job not yet done. So he's taking a slightly hawkish tone in those notes there, saying they're still not gained that magic word confidence on inflation coming down. One of the ECB hawks, Kestrel Kazakh, says they expect continued cuts of the same magnitude unless the economy does worse than expected. But then he says data points to an October interest rate cut, and inflation is not fully defeated, especially in services. Hawke Holtzman, another big hawk, says inflation is on the right track, but it is not defeated. ECB's F.A.C.E says an October cut doesn't necessarily mean another in December, but an interest rate cut in October is an option, so he's not fully behind it. He says markets aren't dictating our moves. One of the Germans, ECB's Nagel, says he's open to a October rate cut. So there's no surprise there, given the state of the German economy, that they want more rate cuts over there. Here's one of the reasons why. Oh, wrong one. One of the reasons why he wants a rate cut. Industrial production year on year down 2.51%. Though they did get a bit of a boost on the month, up 2.9%. This data is really up and down at the moment. We're seeing factory data, as we saw yesterday, coming in much weaker. We're seeing industrial production a bit higher. It's really up and down at the moment. Some big swings in the data, but it's all still really looking negative there. So that's why they're pushing for further cuts. Bank of Italy sees a slight GDP expansion in Q3, slight. It's going to be par for the course. Back to Germany, their economic minister or spokesman from the economic ministry confirmed the report that the economy is likely to shrink by 0.2% in 2024. Over in Spain, things may be looking better on the fundamental side. But Spanish truckers are apparently going to go on strike in various dates, end of October, pretty much most of the way through November to strike dates, then into December. And from December 23rd, their strike will last indefinitely if their demands are not met. So that's 2 days before Christmas. So they're going to be taking a nice bit of time off then by the looks of things. But as much as their economy is doing better, there's still problems underneath the surface, particularly with those truckers. Over to the Fed, Kashkari says we have a lot of confidence inflation is on its way back to the 2% goal. He said the reduction in new rents gives confidence housing inflation will decline. He's not seeing signs of resurgent inflation. So there's a couple of lines that could well kick him in the arse come the CPI data this week. A big focus of that CPI data will be all the housing stuff, sheltered and rents, or owner equivalent rents and that sort of thing, which has seen a bit of an uplift of late, especially coming after it's been coming down. And a lot of Fed heads have been talking about that area of inflation coming down, but it went up. It's gone up the last 2 months and gone up quite a chunk as well. So this is CPI data is going to be one where people are going to be picking the bones out of it rather than just going on the headline number. Anyway, Fed's Muslim says more rate cuts are likely given the economic outlook. He supported a 50-pip cut, but says further moves should be gradual. Fed's Kugler said we'll support additional rate cuts if inflation progress continues as expected, but wants a balanced approach to make progress on inflation and avoid an undesirable slowdown in jobs and economic growth. Just the labour market has started cooling, but the Fed is looking at trends, not single data points. US consumer credit data was out last night as well, just something keeping half an eye on there. We got a big gangbusters 26 billion last month. I think it was just a bit lower than that, and that's obviously been revised up. Was expected to come in at 11.2 8.8 billion, came in just under 9 billion. So a big wash out of that number there. Nothing really of note in the consumer credit data to signal any red flags being waved. Citi, they've another one. They've folded on their 50 pip cut for November in the FOMC. They're now seeing a 25 pip cut, joining a long list of those who got it wrong yet again. Goldies, they see S&P ending the year at 6,000. They think the stars are aligning for the stock market through year end and beyond. That's it. That's all I've got. Anything else you've got, Kay?
No, I think you've covered everything. Gold is also pretty upbeat on Chinese assets. Yeah, he said they see they see the corner being turned. Perhaps it's an early call, but as we said, could be the call if they succeed. We'll see. No, I have got
They've marked a top.
I'm sorry.
Or they've marked a top. I saw them.
Yeah, or they've marked the top. No, I haven't seen anything. It seems that the ECB officials are pretty much aligned there. Okay, we've got the occasional what if the data here or there, but the main countries are behind an October cut. So looks to be a done deal for the ECB next week, right?
Oh yeah, absolutely. That was pretty much nailed on last week. That Lagarde, what she said, and everyone else since, yeah, it's absolutely bang on for a cut in October.
Yeah, but it should be gradual. That's what I think. It should be. It should be gradual. They may not go and do those 50s unless all of a sudden the German hawks go all panicky about their negative growth. But okay, I don't think that will warrant next week bigger cut for now at least. Yeah, it seems to be nailed on.
Yeah,
we don't
there's
find
a
it back in the
conversation
prices though.
It's what?
We don't find it back in the prices. The market is extremely cool about it. Extremely.
Yeah. It has been forecast, or it has been telegraphed, I should say, the last couple of weeks. And yeah, I mean, I think one of the reasons we discussed this last week, the reason why we're not talking 50s here at the ECB is because obviously there's more than one country involved, and you've got countries like Spain and Italy and some of the other southern states whose economies are doing okay, and so that sort of would rule out why they would need to go a 50. Obviously, if you're just looking at Germany as a whole, they should be cutting 75s more than 50s. But as we know, the Eurozone isn't one country, so they've got to take it all as a whole. I think the market's seeing that and thinking, right, that we don't need to get too dovish on them lot. But it is a shift. They were signalling they would go at forecast meetings, and now they're going to stick one in the middle. So it is a little bit of a dovish shift, but as you say, not market taking in its stride.
Yeah, and it's not worth it. We've seen the shift happen, right? We've spoken about it, about even the hawks starting to turn, like Kazakhs and what's the other guy? Well, only Holtzman is still living in his Austrian mountains. There must be something strange in the air up there, but all the rest, even the even the Finnish hawk, right, has come down from his hawkish flight. And what's his name again? It doesn't matter. Ren.
Oh, Ren, yeah.
Yeah, Ren is also come down. So yeah, I mean, it looks that we are going to get some gradual cuts, but yeah, that's if it's not a surprise, the market tends not to trade too much of it.
Yeah, exactly. Right, well, let's have a quick look at what's coming up today. Not an awful lot, I don't think. Quick look through there. No, not an awful bit. Trade balance data from the US and from Canada. We do have a load of Fed heads speaking as well, popping up, and ECBers and what the likes. So that's all going to be pretty boring, no doubt, unless we get anything that we haven't heard before, which I doubt it. They're all going to be talking their book. So it's going to be data front is going to be particularly quiet, as it often is after an NFP week. So we'll get to see on that. Ali's got a question. You took a dollar yen long, tried to ride it through the break of 148, closed 80% of the position, and the rest of the position tried to ride but failed, so removed the rest at break even. I don't know. I'm not sure what your question is, Ali. What are you asking? It doesn't matter what your lot size is. Yeah, I'm not sure what the question is you're asking there, Ali. You're talking about different trade sizes. The mentality, if you're talking about the mentality of a trade and your trade size, like if you go a bigger trade size, does it hit you psychologically? You get more fearful, you get more panicky that you don't want to lose because you've got a bigger trade size. If that's the case, you are trading too big. Again, like I said to you yesterday, mate, you need to focus on getting the trades right first. Forget about the money, forget about the rewards. Get the trades right first. Get into your rhythm of making more than you lose. Once you get into that, it becomes mechanical. It becomes boring. Trade entry, trade management, all that sort of stuff, trade risk is boring. Okay, because for me, it's boring because it's the same thing every time I trade. Risk, stops, management, everything before I hit a button. That's all boring shit, okay? The excitement comes after you've pushed a button and then you have nothing, you have no influence over where the price goes from there. But everything else should be boring and mechanical. And if you can get in that state of mind, then the amounts don't make any difference. It doesn't matter whether you're trading 10 grand risk on one trade or $500 risk on one trade. It doesn't matter because your brain has been trained to think in those boring terms. Okay, so get the method right, worry about the money later. Okay, that comes afterwards. Anyway, let's have a quick look round and about. While I'm sitting here on bonds, might as well have a quick butchers at those. Have seen a little bit of easing off the highs. Some of this may be on the back of just a bit of overextension, maybe on the back of the China disappointment, because we are, okay, I wouldn't call it risk off that we're seeing, but the market has a bit of the hopium trade that this China moves has brought has washed out a bit. You know, most stock markets are currently in the red, apart from the US, in terms of futures and the actuals. Yields have been nudging lower across the board. Commodities have been coming down. Copper down. Commodity currencies coming lower. We're just seeing a bit of disappointment from all that China stuff.
Yeah, that is one thing. I think still some still some geopolitics, and there's maybe one other thing now playing as well is the repeated hurricanes over in the US that may create a bit of additional uncertainty. I just see Angela there saying like low equities this morning following overnight reversals trigger. Yeah, back to mid neutral. I agree on that. We still have to see the fallout perhaps of those hurricanes. There's always a mix of things going on these days, and so you have to plan whatever you want to do and stick to it and not let too much noise come to it. But it's never a clear-cut risk on risk off trade, what we've seen, because for instance, if you look at something like copper weight on the Aussie, but then the Aussie has also been affected by China, well, which may have affected copper, by the way. But then you don't see risk is never equal in several instruments and especially in the currencies and so on. Because if you look at, for instance, silver is holding up relatively well. I mean, if risk comes down, silver could have gotten a beating, but it doesn't. It's very uneven. For me, risk now, the general risk is very difficult to trade, but you pick one or the other to trade. And we've also seen that the market is flip-flopping a lot. One day you can call it risk on, the next day risk off selectively. So it's not an obvious trade, but I do think indeed this today we have this China stuff. Yeah, I mean, hitting the market is a big thing, a big statement, but yeah, it must have had an effect. I'm going to be reserving my not reply, but my opinion about U.S. stocks. It's still a pretty big buy the dip story, but
Yeah.
I would love to see the next couple of days weather-related issues can come into play as well before the week is over.
Yeah, I think if traders who don't know how to look at this sort of stuff, I mean, yeah, the it's also a time frame thing. You know, you come in the morning here in the UK, Europe, and it's all about what happened in Asia, and then the Yanks will come in an hour or so, and then they'll start having their little move and getting themselves out for their day. So then you see a shift from maybe what happened in Asia to what's going on in the US. But I think if you want to look at the Chinese situation through a clear lens, keep an eye on their stock markets to see what's going on. Keep an eye on copper because that's a big barometer of whether China's going to pick up or not, and this hopium trade. And keep an eye on Aussie dollar. Yes, there are other commodity currencies, but Aussie dollar is a big follower of what's going on in China and commodities. So it's no surprise to see that coming down, and we've actually come down to a pretty interesting level, 38.2, bang on the nose for this one of this fib here. So a pretty big level. It's a bit of an area down here around this 67. I don't know where much. I've lost a lot of lines on my charts. I think there was. I don't know where it is. Anyway, there's quite a big area down here. Oh, that was it. It was on the daily. So we've got a couple of moving averages in situ as well, just around this 67 handle. Got the fib there, 15, 67. Got these moving averages, and then we've got this zone here. So it's had a bit of a carve up over the last few days. It's now looking like it's going to go 5 days out of 6 losing after this strong rally. But we're hitting some potential decent support areas down here, down to 66, 60. If we're under there and attacking this 50 fib, then things are perhaps looking a bit soggier for the Aussie. But if it's going to bounce anywhere, this is the area that it may do so, unless things keep going the way they are. So, yeah, keep an eye. If you're looking at China, their stocks, copper and Aussie dollar, and that'll give you a broad overview. Because I don't think gold is really moving around on the China stuff. I mean, we're still stuck in this range up here, still pretty tight, 30, 40, 50 buck range. I've been watching. We keep getting these confirmations on the top. Probably need maybe another couple of confirmations on the bottom edge of it, just to see if we can maintain that zone. But okay, yeah, gold doesn't seem. It would be one that you think would move a lot on China, but it really hasn't.
No, I think geopolitics are playing a bigger role there. We've seen a bit of well, there was this triangle I showed. We went a little bit below. Now we're back in those levels here. 26, 20s, 30s are already a bit of a level. I think it's more like geopolitics still holding gold in its grip right now. Yeah, I don't have anything right there right now because I thought it was kind of enough the rally that we had, but and of course we had we're having a bit higher yields now in the US. Those data on Friday it's not coming off too much because of geopolitics mainly, I guess, and but the way that China will impact is likely. Well, actually, if you see a complete revival in China, gold should actually be lower because they won't buy as much because they can stick their money back into their own economy, right? I mean that's kind of the way I would look at it. Um, because when they saw their economy slowing down, or when they had issues, we heard all those rumors about China buying gold every month. If you trade a Chinese revival, in theory, gold should be lower, right? But I think the rest of the world is holding it up, and I don't know where the next $100 will come from. If you look at this is still just a correction at very lofty levels compared to where we were, and the next move could be up into the 27s, as I said. But really, I'm in between two minds right here and now, because we've seen an escalation, and we've seen Iran and all those countries getting into the mix, but it didn't rally further either. So I'm really very open-minded here. Gold, I wouldn't be surprised about anything, but I know that if it starts to get back above 26, 65, 70, I think then we're going to be trading up in the 27s pretty quickly, and it may come with a very bad surprise at some stage, and let's actually hope it doesn't happen, because it wouldn't be for the correct reason to get up there.
Yeah.
And yeah, that's about what I have to say about gold right now, mate.
Yeah, I agree with that, mate. Right, just a couple from me before I pass it over to Mr. K. At $8 CAD, yeah, as I put on the tweet outs earlier on, we're up at this big level, this 136.50. It's one of those real historical levels that has had a lot of action around it, and a bit of a decent pivot point. If when we're above that and holding above 136.50, it opens the door to moves up to all these highs, 137s, 38s, 39s. So this could be a bit of a significant moment. The last time we were here was just post-Fed, when we got up to those highs. Couldn't quite hit it, but we have got closer this time around. But that was a very significant top that got marked there. You can see all the way down into the low 134s before we've come back again. So this is a big question mark here. If we break above here, I think you're going to need to see it finding support before thinking about kicking on. So I'll be looking for more of a confirmation move above here. I'm not tempted to go with a buy stop, because we have had a lot of action around it. So I don't know. Maybe if I see a break and then a retest and it holds, I could give it a tight one and see if we push on up. But for me, CAD is still a bit of a non-entity. I don't know what it's doing. Sometimes it's moving on oil, sometimes it's moving on risk, and the other times it's a dollar and all that. So this one, it's not one pair that I've got a good handle on in terms of how it's acting. And I like to have a good handle on things like that. One thing I'm going to update quickly is Aussie Kiwi. Got a bit of luck with this one, and the lack of Chinese news overnight. As I said, polarizing the Aussie dollar. We do have the RBNZ coming up. So it's giving me a little bit of profit to take in this move down my shorts from 110.40. What it's also done is give me a bit of margin. If we remain down here going into the RBNZ, if they do go at 50, if I'm wrong, and they do go at 50, then I've got probably a decent amount of margin in there where I shouldn't really expect things to be busting massively higher, because if they do cut a 50, it might be a bit of buy rumor, sell fact type trade. But if it comes with a really dovish message that it's the first of many 50s, then this will probably be motoring well up through 111, something like that. I'm still happy to play it from the short side, keep shorts on, shift it from the RBNZ to the RBA, and keep a bit of a position running in this one on the short side for when those guys will eventually turn, and turn they will. I'm pretty confident about that. Right, Kate, bouncing it over to you, mate.
Yep. Thanks. I'll quickly stay on the Kiwi, because I think the Kiwi dollar is on an interesting level. A bit more in the medium term. If you want to pass me the screen, I can grab it if you want. Okay.
Oh, hang on. I'm marking something
cheers,
up.
mate. Got it.
Got it, yeah?
Yeah, I've got it. Here, if you look at this this trend line, and I've taken the last spike high here. We are pretty much on it. You look this low here, 61, call it figure 10. We are also seeing moving average there. Moving averages there around 61. I think this is going to be an important level here on the Kiwi. Sticking my neck out, looking at how ore can be a bit volatile. I think we can't dismiss the risk of a 50 BP this time. I got this kind of feeling that he will want to underpin the economy, because they've had this kind of like example of what Powell said and did, and it may be a bit easier for the high yielders right now, because the Kiwi is still above 5%, right? For the high yielders, it gives them a bit of an excuse to also go for a bigger one. So keep an eye on 61, the figure, for when the dust will settle post RBNZ. If you see a move below and then breaking back above, I think that will be kind of telling that the market was front running the 50 BPs, and then happy with it, and then starting to buy Kiwi again. So yeah, I'd say really after the RBNZ, above below 61 can be a decider for a few sessions here. All right, this is how I look at the Kiwi going into the RBNZ. I see your question, Catherine. Okay, I'll come to that in a minute. Quickly, silver. Here, when a lot will somewhere depend on China and also other economic data. But if the economic data kind of hold up, I don't think we will see my zone here, but this is kind of a zone that I'm watching now, trying to be patient, anywhere sub 30 down to 29, 60, 70, and 30 and a quarter, 30, 40 perhaps on the top side. This is a bit of a box that I'm watching, and I'd love to see sorry, some continuation perhaps on the dollar side, if we see it, and or a bit of people getting a bit nervous about growth and taking it another buck and a half lower. I'm going to get interested in here, because my long-term view is still unchanged. I would love to add again to I've got only very tiny left right now. But I would love to see levels to add again. I know Stelios is looking at a tad higher. He's looking around here to start adding. Yeah, silver can move relatively fast. I'm going to stick to this zone here. Mix. I haven't looked at the mix for a while, because I was off, Catherine. But we've seen that 19 is holding really well, right? We've seen this 19. Let me just see because it's not really a level that I had technically in there. But I need to refresh. Okay, I haven't refreshed my mix yet. But 19 looks to be a level where the market is watching it. It's a prior high just around here. It's the low around here, high here, just a low around here, and earlier we went on Friday we went down to 1910, and then bouncing a bit. 19 is your first level. If we start to get below 1890, which is about halfway of this of the move that we had from July higher to that spike high, then some longs may need to rethink their strategy. But I'd say for as long as we are above 19, it does look that it's wanting to hold. Don't forget, Catherine, as well, that we are closing in on the U.S. elections, and they will play a big role in all things Mexican peso. Okay, we heard from Trump that if he gets elected, he's threatening to put loads of tariffs on cars imported from Mexico. He's going to be a hardliner, yeah, against Mexico, and therefore also the Mexican peso. And then I haven't seen any news about Scheinbaum, what she said about those judges also. But if only we would take that, it does seem to me like the market has had the news now and is waiting to see whether anything bad will really come out of it. And that for the time being, it looks to be pushed a little bit to the side. So I would say watch the data in Mexico, watch the rates in Mexico. Let me quickly check when the next not before November, the next Mexico. But watch out also what's happening on the data and watch out for politics and especially the US politics. Euromex, look, we had this, okay, we had the big move lower. We didn't reach the 50%, but we had the next one here move lower in the Euromex. Um, and we reached somewhere at the 61.8%. So for the euro mix in the medium term, watch this zone here around 22.15. For the very short term, we are trying to break and hold below this prior zone here around 21.20.30. That is already in the short term, perhaps a little bit of a pivot area, but again, I don't have a very firm idea on this, but it's still a plus 10% currency. So when things go quiet, I would say it would have the tendency to slowly drift lower. Okay. I think we can't couple it to equity markets. We could in the past, but now we have to watch it in a different way. And I think the political side of things is more going to be deciding. But if it's quiet on the political side, I wouldn't be surprised if we slowly drift lower on this one. Okay, but bearing in mind those levels on the dollar mix. Okay, because if the dollar mix hold, euro mix will likely hold as well. That's about what I can say on the mix.
Just to chime
Yeah.
in quickly, because there were a couple of decent headlines from Mexico
Okay.
last week. Scheinbaum said she's going to be pushing for 12% wage hikes next year. And the deputy governor, Banxico, said that rates are likely to stay on hold for some time now.
Whoa.
So,
okay, so
that's
that likely explains the fact that the Mexican peso has strengthened somewhat. Well, somewhat,
Yeah.
5%. Okay.
that's
All
a
right. Yeah. Okay. All right. Cheers, mate. I think we've said enough for today. I mean, euro dollar. I think euro dollar is one that. Oh no, I wanted to show dollar yen though because look where we stopped this morning. I'm slightly disappointed because I missed an entry here for a pip in the dollar yen. I had it bid it at 33 and they printed 34 as a low. But okay, anyway, I mean next. Could be worse, could be raining as they say. Look where we stopped in this dollar yen, okay? Prior high in the 20s, prior high in the 20s, 147. We went through and now we went to roughly retest. It's also still the 78.6. I know we've already put in another move, but it is there's still because it's been a high here as well. I still would like just to keep this line in here because I think it's a relatively short-term important little level here in the low 147s on the dollar yen, and for as long as that holds, I think this perhaps correction, and then we could continue to see it a bit higher again. Now, I'm coming back to what we said yesterday. Don't forget the Japanese officials have already been a bit vocal for the start of the week, so I don't think that we are going to really ramp higher, but I still have kind of an idea that we may be in for a retest of 150 at some stage, providing that, and when is it, on Thursday or tomorrow? Thursday, right? The CPI in America.
Yeah.
Providing that CPI doesn't crash away, okay? CPI will be the next big one here, I think. All right, but it is significant is a big word, but it's interesting at least that we're holding this retracement level and just around those prior highs. If we get below there, I think then we may see 146.5, or perhaps even back a bit lower. That is it for me. Back over to you, Ryan.
Thank you very much, mate. Good stuff as always. Thank you everyone for joining us here at the Flow Show as always too. Have a great day ahead. Trade safe, trade well, and we'll see you all tomorrow. Thank you very much.